tuning into Mirror Now, and welcome to another episode of Investor's Guide, where we help you understand all about saving, investing, and how to make your money work for you. And of course, you can get all your personal finance-related questions directly answered by the experts that we have here with us. So whatever your question is, do send them in. You can email your questions to us on investorsguidemrn@gmail.com, or you can simply call us on 022-2499-0546, or you can even connect with us on both Facebook or Twitter. Details of all of that flashing on your screens. But on today's show, joining me is Kalpesh Ashar, a certified financial planner. Kalpesh, thank you so much for joining us on Investor's Guide. We've got, of course, a whole lot of queries. They've been pouring in. But before we get to the queries, I think it's very important at this point to talk about the current market environment, the current situation. How does one manage the money given that the markets have been so volatile? We've seen a lot of ups and downs, and at times like this, usually investors, especially small investors who are putting in money every month into things like mutual funds, tend to get scared, tend to panic, start asking questions of whether money should be taken out of their investments. So let's talk about that really. What would first off be your immediate advice when we're talking about managing money in these markets?
Yeah, so you're absolutely right. There is the panic in the markets. There is lot of talk, and I would say also not very valid talk coming from all quarters, because everybody seems to have a say on the economy, and people who are not even, I would say, fully relevant are giving their own views on economy. Now, what that does is has a very impairing effect on the retail investor. And we have been very fortunate thus far that this has not impacted the mutual fund SIP inflows, which we are still getting in at the same rate of around 7,000 to 8,000 crore per month. So I think that is a little bit of I would say applause for the small investor, that he has still not, I think, given up on it, and he is continuing. But it sends a lot of alarming signals, because the real pullouts are happening from the foreign investors for all the various reasons we know, and we can't also ignore the fact there is a certain a slowdown in the economy, and the auto sector is the one which is surely bleeding, I would say. But a retail investor should understand that he should not get carried away by all the loose talks on social media or whatever is happening about, because that is happening still at a very macro stage, and he is doing his SIP. And let's understand what that SIP is, that we've been inculcating this as financial advisors, that the SIP is your monthly amount, is your monthly contribution which you are taking out as an investment after considering that all your other requirements of your daily lifestyle are taken care of. So an SIP should not be stopped in this situation, and even keep away from all the rumors and all those things, because in an equity market, when you're in for the long haul, you are bound to face such situations. And people, I think, unnecessarily compare this to the 2008 crisis, which was more of a global crisis, whereas this is what we are seeing is more India centric. It is little bit of a temporary lull in the economy, I would put it as, and we should take it as in our stride that these things do happen. And these are the moments, actually speaking, which a long-term investor should be waiting for, that at these lower levels, his regular investments are buying him more units. So if his allocation to investments is done in a very discreet manner from the beginning, without getting too gung-ho from the beginning about equity, and he's disciplined, he's level-headed, then I think this should not worry him. But always keep your ears and eyes open and keep reviewing your portfolio.
Absolutely, Kalpesh. In fact, let's just go through, some of the important pointers that one should take cognizance of as far as, managing money in these volatile times are concerned. So, for example, Kalpesh, some of the most important points would be to ensure that you stick to your plans, you stick to your financial goals. And this is also where the importance of having financial goals really comes into play. The other important thing, of course, is not to panic, to ensure that your portfolio is diversified, so that which means that you have allocation to equity, you have allocation to debt, you have small amount of allocation to gold as well. So to ensure that when one asset is facing a tough time, you have the other assets to fall back on. And most importantly, don't try and time the market, and also consult a financial planner to review your portfolio as and when, especially in these volatile times. Kalpesh, if you would like to elaborate on those points and perhaps add something.
Absolutely, and I would like to start from the last point. If you are taking genuinely good, unbiased advice from a financial planner, he is the one who knows your complete profile. He's the one who knows your own goals. He's the one who knows that how much can you invest and in what assets are according to your risk profile. So consult a financial planner. He's there to handhold you and not let you go astray by loose talk or people telling that this is time to wind up and get out of it. And I think one thing is there, Avni, we should all remember that in equity, if we are to actually redeem our investments or sell our stocks, that is the time we will be actually, I would say, booking a profit, booking a loss, I mean to say. So till the time we do not, panic and actually press the button of selling our investments, we do not book a loss. So apart from that, whatever we are seeing on the screen is all notional. So we do not need to, get into that. And the other aspect which you said is timing the market. I think it's a complete futile exercise, because nobody practically under the sun knows where is the bottom and how long is it going to stay there, or how quickly is it going to recover. So keep, I think, a keen eye on your own personal finance and your own budget, because I think the word budget has triggered this entire thing on a full scale downside since July 5th, because there were rumbles in the economy, there was something not going on well, but I think the budget triggered it a lot. And I think that should not be the case generally when people look at their own portfolios or profiles. I think asset allocation is the other one which you said.
Yes.
Very, very important aspect of personal financial plan. So if you have not put all your eggs in one basket and you are diversified enough, you will always find there's certain positivity in one asset class. So as we are seeing right now, that the interest rates have reduced, the debt funds are doing well, gold is at an all-time high. Now, I'm not advocating gold as a major component of your portfolio, but surely that should be some part of your portfolio which is on a non-risky basis, and looking at your short-term goals also. So these components, I think, hiring a financial planner, asset allocation, not giving into rumors, not stopping your SIPs, and looking at planning with goals. I think if you have those things embedded in your mind and your investor mindset, I think you cannot go wrong. The economy will pick up. It's a matter of time, and I'm sure one thing I would like to also convey here, that the people who are running the show, the economists, the people in the government, are also intelligent people. They also know what they're doing. We might as well give them our opinion, but they also know what is good. So we all always have said that running a government is a very thin line between socialism and capitalism. So they have to toe that, and we have to understand that there might be hard times and there might be easy times in the market, but all that has to be taken in stride when you're investing in equity. So
right.
Keep that in mind, and you can, I think, continue your equity journey.
All right. Let's quickly get in some of the queries now. Aditi Khandare has written in. She says, I'm a fourth-year undergraduate student. I've always been fascinated by the money I could make by investing. I've earned 50,000 rupees from my internship, and I would like to invest it so that I can learn how it's done before I start working in the next 2 years. Can you help me with where I should begin to learn about investing in equity, and when is the best time to start? So Kalpesh, she's not even started working. She obviously has an interest in investing and in learning how to invest, which is always a plus point, because then you can sort of focus a little bit more and ensure that you do everything right. But what's your advice for her?
I think that's a fantastic premise on which Aditi is starting her journey, because what she's ticking all the right boxes. She's young, She's telling that before she starts actually, getting into the career mode, she has some small amount with her, and she wants to understand how things move, and she's wanting to experiment with it, but doing it the right way with complete knowledge and instruments in which she's knowing the risk, what they are supposed to do for her. So for Aditi, I would suggest is two things. One is, Aditi, that whenever you are investing, I think fix up a written goal along with it. So when you fix up a written goal, it automatically tends to have your focus fully on it, and your money will have a purpose of investment. So if you have a short-term goal, allocate that much money to short-term debt funds or something like that. And the long-term is, obviously, we always suggest the equity. And do an asset allocation. Do not keep everything for equity or for debt, trying to be too conservative. And for you, mutual funds will be the right way, because they'll give you an exposure to the capital markets. It's a passive form of investment. And you need to also monitor your portfolio. And if possible, also do a little bit of knowledge searching on your own. If you can't, you can always take expert advice.
All right, well, Aditi, hope that answers your question, and wishing you a very happy journey of investing now going forward. The next question comes in from Tushar Bhatia, who says, my wife and I are 33 years old. We earn a combined salary of 2.2 lakhs in hand. How much should we invest in SIPs? Kalpesh, here, obviously, a lot of it depends on what their monthly outflow is, what are their expenses, what are the liabilities on their heads, any loans if they've taken. But overall, what should ideally be the minimum amount that one should try and invest from this kind of a salary?
Yeah, you're absolutely right, Avni, because when you decide to invest, more importantly is when you create your financial profile, what is necessary is to understand your cash flow, your own personal cash flow. And for that, you have to understand how much are your fixed expenses, how much are your variable expenses, how much is your liability if you have a loan, you have an EMI going, and finally, what is the amount which you should mandatorily invest. So that amount on a financial planning platform, I would say, we always suggest that it should at least be 20% of your monthly income. So if your, God forbid, if your EMI is higher or your expenses are higher and you're unable to even invest that amount, obviously 20 upwards is always preferable, but 20% is ideal from your monthly income to start an SIP or any investment mode which you would like to get into.
All right, another question coming in from Sunil, who says, if I save 2,000 per month, depositing it in the bank for 5 years, will that make a difference instead of saving the same amount and keeping it with me? Kalpesh, from what I understand this question, he's just trying to, understand whether he should sort of just keep it tucked away somewhere at home versus putting it in a bank or in a deposit is really his question. I'm trying to understand how much of a difference would it make if you can just help him out.
Avni, this is a typical investor's myth, and I would like to make a big clarification here is that when you are saving, I think you're just giving into an emotion, but when you're investing, you are actually doing a concrete action. So there's a world of difference between saving and investing. Saving will just help you, keep your money stacked away and at no particular, high growth oriented product. But whereas you are investing with a purpose, investing with a goal in mind, obviously you are looking at capital market instruments, and there is a risk associated with it. So people who invest create wealth. You cannot create wealth by saving money. So understand that difference, and you can keep your money in a bank stacked away for a contingency fund, for an emergency, for anything which is very, very immediate. But for anything apart from that, I think money lying idle in a bank account is not really a great idea. So start investing in either a mutual fund, or even you can start looking at investing in I would say corporate FDs or something like that.
All right. That's as far as the difference between saving and investing, and that's extremely important and crucial to understand, and important to understand why when you invest it makes a lot more sense, and the more you invest, the better it is. But we've got a question here coming in from MK Salyan, who's a 70-year-old man, says, I want to make a one-time investment of 1 lakh for 5 to 10 years. Please advise me which is ideal for me to gain maximum returns. Well, Kalpesh, a 70-year-old person here who wants to invest. There are a lot of options, a lot of higher interest that people, senior citizens really get. If you can just take us through what are the options available.
Yeah, Mr. Salyan, you being a senior citizen, obviously there are a host of options which you get as a benefit more than the normal, individuals. So just to highlight it, you are eligible for the senior citizen savings scheme of the government, which as on today is offering an yearly interest of 8.6% per annum with interest payout on a quarterly basis. It's a government scheme, so obviously it's secured. Then you have even a good option, and there you have a limit of you can invest up to 15 lakh rupees in your own name. And then you have the Pradhan Mantri Vay Vandana Yojana. So that is again where you are given a limit of 15 lakh rupees to invest, and that gives you a guaranteed 8% for the next 10 years. Again, a government scheme. So you are assured of better, I think, options than a conventional bank FD. Now, if you are already, allocating your money sufficiently to fixed income, being a senior citizen, I don't know your complete profile, but if that is taken care of, then the next best option is that we should not, turn a blind eye to the fact that nowadays the lifespan has increased. And if you do not have an exposure to equity, and if you are giving yourself another 5 to 10 years, I think that's a good time frame. You can look at hybrid equity-based mutual funds, which has a mix of equity to around 65% and 35% in debt. So that is not a very aggressive equity-based product. So you could look at that in parking your money. But understand one thing, at this age, I'm sure you know that, but I'm repeating it for you. You need your principal to be, more or less secure and a regular income generating out of it.
Yes, exactly. In fact, Kalpesh, I wanted to just focus on that point a little bit, because a lot of senior citizens really write in asking where to invest as one part, but invest in avenues which can give them a regular income, because obviously here we don't have the concept of sort of a pension plan which comes in once you get old. So what really should be the options one should look at?
So now, Avni, you need to create a basket of products for senior citizens to generate that regular income. You cannot depend on one and just say that it will be done. So I would suggest that even if your money is parked in mutual funds, you have now the SWP route, the systematic withdrawal plan route, where you can get a fixed amount from your investments, and that comes at a particular date. So there's no dearth in the cash flow. Secondly, the two schemes which I just mentioned both have a payout option, the senior citizen savings schemes and the Vay Vandana Yojana, which is a pension scheme, and though they are taxable. And the last option you can look at is your corporate FDs. And in that, you should only look at now, given the current situation where everything is looked at with a very doubtful eye. Only AAA rated corporate FDs should be looked at. In that also you have an interest payout option, and obviously the tried and trusted bank FD. So it should be a basket of products which you could have with you.
All right, we've in fact got a caller, Maitri, calling us from Mumbai. Thank you so much for calling us. Go ahead, what's the question that you have?
Well, my question is, nowadays we're getting a lot of messages regarding mutual funds.
Yes.
That mutual funds are becoming, the fund house is becoming very volatile.
Right.
So, is it safe to invest in mutual funds, or shall we stop investing for some time and let's see, because the market is also nowadays volatile. So, getting messages from different experts that some certain fund house may just one day announce that they are bankrupt because they are not channeling the money to the companies that they are promising us that they would. So,
right. Maitri, do you already have investments in mutual funds? Have you already started any kind of a SIP?
Yes, we have. We have certain existing SIPs.
Okay. Okay. All right. Well, Kalpesh, I'm going to hand it over to you. Obviously, this is exactly what we were talking about, that there are a lot of, rumors also going around, probably exaggerated messages, etc., that are going around. How does one alleviate fears like Maitri has?
So Maitri, first of all, your fears are, well received, that there is a certain panic. So I do not deny that, but that is where, you need to understand and where we need to step in as advisors and tell that the mutual fund houses, the AMCs, are what in the system, they are all controlled by a trust. So there is no question of a mutual fund house going bust. So you might have heard of instances where there are mutual funds which are being merged or being taken over by other financial institutions. So that is a possibility. But the investor's money in a mutual fund is run by a trust. So whatever is the news which you are getting could be market related and could be the instruments in which a certain small portion in which mutual funds have invested, because you should understand that they are all investing in capital market related securities. So be it debt, where all of a sudden we are finding a lot of bad paper and defaults and downgrades happening, which is creating a lot of fear in the normal investor's mind, and they are bound to, because it's a debt market. It's not equity where you are supposed to live with volatility. So that is there, but it is not the entire, I would say the corpus is invested in one company or something. There could be varying proportions, and that could give rise to volatility. It is regulated, it is monitored, and actions are being taken on it. So the investor's interest is kept paramount by the regulator, which is SEBI in this case. But the overall conditions which is more, I think, worrisome, and you should be talking about that more. And like I just explained in the earlier part of our show, that in these cases, where if you have your own allocation in place, if you know how much you're going to invest for what period, in which instrument, in fact, for equities, these are, I would say, not the best times, but at least suitable times to invest, continue investing if you're all ready. So don't panic on that front. Mutual funds will not go turtle as a fund house, but you need to keep your faith in your investments, and surely I think over a period of time things would turn around, because these all things move in cycles and in phases.
Absolutely. Well, Maitri, hope that answers your question, and you can always write into us with your specific portfolio if you want a proper analysis of which are the funds that you've invested in and whether you need to make any changes, or you can simply consult a financial planner to help you out. But most importantly, like Kalpesh was pointing out, don't panic in these volatile times. Thanks for calling us. All right, let's shift focus. We've got a mail coming in from Krish Iyengar, who's 64 years, who says that I would like to invest 20 lakhs for at least 3 years. I'm retired. Please suggest which instrument I should invest in with a moderate risk. Well, Kalpesh, moderate risk appetite, but a significant chunk of money. What's the advice?
So in that case, again, being a senior citizen, I think he's 64. So he comes into that category, and if allocation, we don't know the full profile, we always like to look at a full profile. But in that case, I would always say that, you can always have the corpus divided, at I would say 60-40 type of a ratio. 60% could go into the fixed income space. And in fixed income, like I said, create a basket. You don't depend on one thing, because you understand that even tax efficiency needs to be considered when we are investing. So 60% of your corpus could go into fixed income, and where there is some surety, some little bit of volatility in fixed income also, because let's get one thing straight, that there is no risk-free product in the entire market. Everything comes associated with a risk, and the remaining 40%, because you are 64, could have a blend of balanced funds and equity funds going ahead. But that could reduce with your age moving up also, and according to how the portfolio is performing and your requirements. That is more important. And in this, I would suggest that you also look at, apart from debt funds, only AAA rated corporate FDs. So those need to be looked at, because they offer a little bit of higher rate than a conventional bank FD, but albeit coming with that much little bit higher risk. Please understand that. So you can distribute that portfolio accordingly and make your investments.
All right. Well, we're almost out of time, but very quickly, Kalpesh, if we can, push in one final question. Amol says, I'm 50. I have various investments in LIC, Saral, PPF, HDFC Super Income Plan, HDFC Opportunity Fund. Now, for the next 10 years, I wish to invest 25,000 per month through SIPs. What would be your advice?
Amol, the advice for SIPs I'd surely give, but before that, whatever little instruments you've mentioned that you're already invested in, I see a couple of insurance cum investment products in that, and those are basically the endowment traditional products. And a genuine advice which I would like to give is that these are products which neither offer a sufficient insurance cover nor give returns which are, I think, even hardly inflation beating. So take a review of that. And for insurance, we always suggest that a term plan is the best thing. Stay away from the others. As far as the 25,000 SIP which you would like to do, and considering that you're 50, I think you could look at investing in 2 or 3 funds. You could start with investing in an index fund which will cover your large cap space. So you could go in for the ICICI Pru Nifty Index Fund, which is a pure index fund. It just mirrors the index. The second one you could look at is the SBI Focused Equity Fund, which is a multi-cap fund. So that also has been a good performing fund.
Right.
So you could divide your investments between the two equally and start investing.
All right. Well, Amol, hope that answers your query, and hope you get down to investing soon. But on that note, we're completely out of time. Keep all of those queries coming in. And Kalpesh, thank you so much for joining us with those queries and all that perspective. On that note, time to wrap up this edition of Investor's Guide. We'll be back next Friday at the same time. So until then, keep sending us all your queries, and we assure you we'll get them answered here. Thanks for watching.